Hello and welcome to Switzer Investing. I'm Peter Switzer, and on tonight's show, Rudi Filapek-Vandyck of ARE shares with us the 2 or 3 stocks he likes right now. Or should we heed the old market maxim, sell in May and go away, come back on St. Leger's Day? We'll see if Rudi supports that old maxim. The CEO of EML Payments, Tom Cregan, on why the market lifted its share price 17% in a week 2 weeks ago. We'll ask Tom the reasons for that. And then Paul Myliotis explains why M Square Capital is a fixed income alternative for those looking for a bit better return than term deposits. Ying Yi Ann Cheng of Coolabah Capital, a 24 gold carat expert on interest rates, tells us whether our Reserve Bank can really keep interest rates at these low levels until 2024. Do you really believe that? Really? That's the show, so let's go and kick off with Rudi Filapek-Vandyck of ARE. Welcome to the program, Rudi.
Well, Peter, as always, it's a great pleasure to be here.
I was thinking as I was driving into work today, and I knew I was going to be interviewing you. I thought probably for nearly at least the 10 years of my program on Sky Business, we would once a year talk about should we sell in May and go away. And I think you and I have tossed it around at least 8 years, but maybe even 10 years. Yes. And so I can't help it. May is getting closer. Yes. What do you reckon this year, Rudi? Is this going to be a sell in May and go away year or not?
Let me answer that question by referring back to my own research, which I did a couple of times in that matter. It works in some years, but it's far from a guaranteed strategy. So, and there are years when it simply doesn't work. Now I do know that maybe the fact that the share market has performed so strongly so far, that might sometimes be an indication that we might be due for a pause, and maybe come May, that's what the market thinks we should do. If only because in the US, as you know very well, in the US we're doing all-time highs every day now. And Australia, if we keep on going, it won't be far off either here. So maybe if we can rely on history, maybe it is time for a little bit of a pause come May.
Yeah. Now, and we should kind of explain that historically, before the age of the internet, a lot of stockbrokers and investors would clear their books, go on holidays, and then come back and start working again. So they wanted to lock in their profit and make sure they were able to see what their investments were doing, because when they went off to their beach holidays or their skiing holidays, whatever they did, they just couldn't actually access the market, which they can nowadays.
Yes.
But why don't we just ask this question then? If you saw the market sell off, given the likely strength of the economic boom over this year and definitely next year, given all the spending and the very low interest rates, would you see that as a buying opportunity, particularly if really good companies did get sold off, in a May and sell and go away situation?
Well, the obvious answer is, of course, yes. Maybe the added commentary here is that I picked up from a few strategy reports recently that some people are out there advocating for people to have a little bit of cash on the side, because if the market does sell off, and they are thinking it might be to the terms of 5-7%, something like that. Yeah. They would recommend adding aggressively into shares that fall. That probably, obviously, I think it's with the caveat that we do not want too much trouble from the bond market here, and that could cause some trouble. But assuming that doesn't cause too much trouble, your statement has to be correct. That if this economic recovery continues, then the share market should, all else being equal, should end up higher, even though valuations are far from cheap. But the recovery should take care of that.
Yeah. And interest rates are just so low. You and I, we would always compare what are the interest rates telling us we should do, and therefore are stocks attractive or not, and that is unbelievably low. Rudi, I interviewed Hamish Douglas earlier this week, and what he said to me was he is worried about some US tech stocks like Tesla, which is not necessarily a tech stock, but it's a high-flying growth stock, and Bitcoin, that they are just so, in his mind, so overpriced. They had that sort of dot-com bust feel about them, and that could rattle the market. And he made the point, he said, I like tech stocks. Microsoft is my biggest holding, but there are just some kinds of tech stocks that their valuations seem ridiculous, and they could rattle the market. Do you agree with that possibility?
Yes, absolutely. I think central bankers are carefully watching what's happening with cryptocurrencies. Because there's ever more money going in there, and anecdotally I pick up that ever more money is going in there, also from SMSFs, from retail investors. I mean, that's how we humans operate. If something keeps on going up, we really think we should be part of the party, basically. And there's an argument to be made that the further that goes on, that if it, at some stage, if it does deflate, it will have a profound impact. It might actually have an economic impact at some stage because so much money goes lost. Having said so, I mean, predicting these things is incredibly difficult. And I mean, I remember the crazy hazy days of the late 90s. Some people were predicting in 96 that it was all too heated and overvalued, and we had to wait until March 2000 before it finally deflated. So, I mean, probably the best statement I came across recently was that a bubble makes a fool out of all of us, either during the bubble or after the bubble. So either you look a fool when you don't participate, and afterwards when it deflates, you look a fool because you did participate.
Yeah. It's absolutely true. All right, mate, let's go. I asked you to tell us 2 or 3 stocks that you do like, and with all those caveats around what might happen, there could be sell-offs, and then ultimately it's good to have stocks that can weather. And you've always been an all-weather stocks kind of guy.
Yes.
So what are the 2 or 3 stocks that you think look like good value now?
Well, I'm having a little bit of a different approach, Peter. I heard you saying that when you drove to the studio, you were thinking about me, and I thought, well, that's quite funny because I was earlier thinking that when I was on your show a couple of times, I used to talk about the automobile sector in Australia, and it's a sector I very much like. So, but before we go there, I like to throw in 3 stocks which I believe that if you have a 3 to 5 year view, that they will be significantly higher than where they are today.
Yeah.
And I think those stocks are CSL, they are IRE, and they are Hub24. None of them is related to the automobile sector. I'm personally quite a fan of the automobile sector. Of course, there are a lot of challenges coming towards that sector. It has had some challenging periods in the terms that there were no sales of new cars for a very long time. But that sector is really reliving now and recovering very strongly. And some stocks actually, of some companies actually haven't really had a tough time in that sector. One stock that has particularly done very, very well is the old AP Eagers, nowadays called Eagers Automotive. Now that one I wouldn't chase here, but there are stocks, for example, like a Bapcor, which is a very long-term favorite of mine, and which I noticed, which is finally getting some traction here. And I think investors should still not be afraid to get on board. There is still, I think, a lot more to come there. Similarly, there is also Super Retail, which is essentially a competitor of Bapcor. Obviously, there's more to Super Retail than simply cars, but it is a very important factor in that business. And Super Retail actually offers a very high dividend yield here because the share price is quite cheaply priced. And I think that the market is mispricing Super Retail here, too afraid that some of the parts of the business have done well last year and can't repeat that this year. And then obviously in the same sector, you can also argue that there's still an ARB Corp, which has done really, really well, but continues to churn out very strong growth numbers. And if I believe the analysts, they think there's still more to come there. And you also have a company like GUD Holdings, for example, which is equally in the auto parts.
Now, Rudi, that last one again was?
GUD,
GUD, yeah, GUD, yep.
Sometimes pronounced like God.
God. Yeah.
And there is, if you are a little bit more speculative, there is a company in that sector which is called AMA Group. And they have had, they lost their way a little bit over the past 18 months or so. And the share price reflects that. So if you take a punt that sooner or later they will get it right again, that share price could easily double.
Okay. Yeah, so there's a great collection of car-related stocks. And it is interesting, mate, even the second-hand dealing data, which we never used to look at before, it's really on the rise because it's very hard to get new cars at the moment because of the coronavirus. So if people are holding second-hand cars, companies like Babcorp that service cars, it's going to be should be well positioned at least for a couple of years. But Rudi, let's go back to your first three. The CSL, totally agree with you. What was the second? What was the second one?
Second was IRIS.
IRIS, yes. Now, a good friend of mine is now the COO of IRIS, Michael Blomfield, really smart guy. And this has been a great company in the past.
Yes.
Kind of lost its way. Why do you like it now?
It's very cheaply priced, and if you look at the price chart, you'll see it has not recovered from 2020 basically. It's actually lower now than it was last year. My belief is that is because of the UK economy. The UK economy is a very important part of the business, and of course, when Boris Johnson doesn't get his act together, that weighs on share prices here. But the UK is now doing well with the vaccine program rollout, etc. I think that's the reason why IRIS recently, the share price has started picking up. And I would say the same thing as with Babco. The fact that the share price is already moving upwards should not deter investors from getting on board, because there should be a lot more valuation to be had from that share price.
Now, finally, Hub24. For people who don't know what Hub24 does, could you explain that and tell me why you like it?
Yes, people are probably more familiar with net wealth, which attracts a lot more attention from investors. But it's actually a financial platform where people go on and they can allocate their money towards fund management and towards ETFs and the likes. So we have a few independents in Australia. Hub24 is one of them. Net wealth is another one. And they are taking market share away from the likes of AMP and the banks, etc. And that is a process that has multi-years aspects to it. Recently, people got a little bit afraid because the banks are revising their agreements with those companies in that they will not get as much money for the cash that investors hold on those platforms. That is a short-term headwind. It has depressed the share prices. I think that's an opportunity because those companies grow fast enough to compensate for that. By the way, Peter, I forgot one company to mention. It's car sales. We should not forget car sales in the automobile sector.
Okay, fantastic, Rudi. As always, it's great to get your insights, mate. And we'll catch up with you in a month's time or so and just see how well those great companies. Though you did say those three are for 3 to 5 years out.
Yes, absolutely.
All right, mate. Thanks for joining us.
Thank you, Peter.
Well, I'm joined now by the CEO of EML Payments, Tom Cregan. Tom, thanks for joining us.
You're welcome. Thanks, Peter.
For people who haven't come across EML Payments, and they might not be regular viewers of this show because I actually have talked about the company many times, but I probably haven't gone as deeply into what you do as I probably should have. So just tell us about the many areas where EML makes money.
Yep. I mean, we're at our heart, we're a payments processing business. So we run, payment technology platforms that enable, various corporations or governments to use our services for any range of reasons. It could be the sale of gift cards, it could be a distribution of welfare funds, it can be a salary packaging. I mean, we're managing thousands of programs. I think it's well north of 3,000 now in 28 countries in at least more than a dozen industries, buy now, pay later being one of the more recent ones. So we're running a technology platform that manages payments, and different customers in different verticals or different niches will use us to achieve whatever they're looking to achieve. So if it's If it's expanding their market reach, they'll use us. If it's loyalty, they'll use us. If it's just distribution of monies, simple as that, for welfare monies and other things, they'll use us. So that's the core of the business. We make money typically from charging transaction fees on those transactions, as well as interchange that we're earning. So every time that gets used through the network, we're getting a small clip of interchange. So net, our average yield across every vertical, every customer is roughly 90 basis points thereabouts.
Yeah.
On 20 billion of payment volume.
Okay, give us an example, Tom, of how EML works with welfare payments.
So in the UK, so in particular with the company we acquired last year, in the UK, a company called PFS, they've got over 500 government programs. Now most of them are going to be local government, or what they call local market authorities. So they'll run all sorts of programs. They'll run welfare programs. It could be education assistance programs, food stamps, paying police, paying people that are living in council homes to kind of upgrade and upkeep their homes. So it's just a way of paying them without that money going to their bank account, because that money can then be restricted. So they can pay, if they're paying someone, £5,000 or £10,000 to upgrade their council flat, they need to make sure that £5,000 or £10,000 doesn't get spent, down at the racetrack. So the money goes through us, and then we have a range of controls that make sure the money gets spent on that purpose. But outside of that, the UN is one of our customers. So the UN, we have refugee payment programs that are funneling money to refugees for assistance. We've got programs in Scandinavia where the most recent one is for released prisoners from the prison system that are released, and opposed to them just being left to fend on their fend for themselves. They're paid money by the government, but that money is then again restricted on what they can spend. So but I think 560 different government programs at the moment.
Yeah. Now, one of the points I think Julia Lee made to me probably a year ago is that EML was not advantaged by the coronavirus because two of your big customer bases are casinos and shopping centres. Is that, I think she's right, because the share price kind of reflected it, and as reopening trade became more believable, your share price started to respond to it. Is that a really important part of the business?
We never had much in casinos. It's mainly sports betting and wagering customers. So we don't have any active casino kind of customers. The shopping mall piece was a really sizable part of the business. So if I went back, 2 years ago, shopping mall gift cards were half the business. So they were half the earnings, half the revenues. And we had grown that business, so we'd grown through organic and inorganic acquisition, but we ended up with I think 1,100 shopping malls in various countries. I remember it like it was yesterday, but in February last year, when we started hearing of this thing called COVID and wondered what that would look like, and then by the end of March, we were really starting to see that bite. And in April, they were all shut. So 97% of our programs closed in that gift business. The beauty of that business, though, and it's one that over time has been oft questioned, but with gift cards, as the issuer, you do have this thing called breakage, or effectively the leftover funds that are left on gift cards, which we would normally keep half of, and we would share half of that with the shopping mall, with the distributor. And the reason that revenue line exists is these cards are being sold for nothing. So if I'm buying a $100 gift card in a mall, I'm paying $100 to get $100 of value, but it still costs money to print the card. It still costs money to distribute the card to the store. So it's not free getting it to the distribution point. So breakage exists and we make money on that, as do our partners. So our accrued breakage revenue as at March of last year was 35 million, because we're selling, several hundred million a year. So even though our unit sales went down by 97%, our cash flow didn't. Our cash flow was protected by that, by the unwinding of those accruals. So I think that was something we knew in our back pocket would happen, but it's something the market now got to grips with pretty quickly, that breakage is both an offensive and a defensive thing, because even if you're selling nothing, which we were in April and May, you're still generating cash, and that was key. So we even though unit sales went down, and they're still down. Things are improving, I think, in the US. In Europe, we still see lockdowns everywhere, snap lockdowns, long-term lockdowns. So our unit volume would still be half probably of what it was pre-COVID, but the rest of the business has grown, substantially. So it's now, whereas gift cards in malls were probably 50% of the business, today they'd be 20. So we've just managed to hedge the risk a bit and kind of have more of a balance in the revenue line.
But is it fair to think that if in a year's time the shopping world is getting back to normal, that should be a nice tailwind for the company?
Yeah, it should be, because really it's almost one replaces the other. So this year, as malls are closed, yes, you can't sell anything, but nor can they be redeemed. So breakage rates have actually gone up this year because of high redemption. Now, if customers want them extended, we do extend them. So we've done that for thousands of people in Europe, for example. So if people call us, they can extend them. It's just typically not something that you would do when on average it's $2 a card. I think people have more things on their mind than $2 on a gift card. But this year, we would expect the volumes to recover on the unit. So our breakage rates will probably go down as malls open and social distancing rules change and crowds can get back into property. But our volumes will go up too. So I think if we recovered from we're 50% down on where we were pre-COVID, so that would be it's in the hundreds of millions of dollars. So it's 10 to 15 in revenue thereabouts that we would expect to kind of flow back.
Okay. So the market got excited about an acquisition you talked about last week. Tell us about that and what kind of implications it's going to have for the bottom line.
Yeah, I think it's a great little business. It's not an accretive business. That's the first one we've bought that is really about product reach more than anything else, but no immediate accretion. Like it's about 12 million Aussie revenue and $1 million and a bit Aussie EBITDA, but we're going to reinvest all of that into sales. So it won't make anything for a couple of years, but it's a business in what's called open banking, which has been on the European radar since 2018, and it's really in Europe and other countries led by regulation to try to get more competition into the payments space. And so for us, it enables. So in Australia, I could send money from my NAB account to your bank accounts, and I could get that done, pretty quickly, and I get that done seamlessly. But we've got pretty terrific banking infrastructure in Australia to enable that to happen. In Europe, where you've got 5,000 banks, and in America, where you've got 5,000 banks, it's far more cumbersome, and you're having to use the SWIFT network and things like that might cost you $40. They've got FX components to them. So open banking in Europe is really the ability for me to send you money in real time, instantly.
Yeah.
Now the benefit for that, it's really not a consumer to consumer thing. It's more of a consumer to merchant proposition. So if all the technology and regulatory that underpins it is one thing, but to you as a consumer, what will happen is you'll walk into a store, in the UK or in Europe here too at some point, and you'll have a range of options, and that'll be, I want to buy those jeans using, Afterpay or Zip, my credit card, my debit card, or simply pay with my bank. And that will be all it is. And you're going to click that to pay with my bank, because it'll be a choice for you to just pay it from your bank. And the payment provider, being us, is just going to take that straight out of your bank account and put that straight into the merchant's bank account. The benefit for the merchant is instant cash flow, as opposed to a credit card where they might be paid the following day. So they get an instantaneous benefit there. But they'll get it at lower cost, because they might pay 1.2, 1.5% on a credit card fee, because credit card fees have risks. They've got risks of fraud and risks of chargeback and people saying that, hang on, my credit card details were stolen and what have you. But with open banking, I'm looking into with your consent, I'm looking into that balance in real time. I know exactly how much money's there, and I'm taking it out and it's cleared in real time, and I'm sending it to the merchant in real time. So by comparison, as opposed to paying 1 to 1.5%, it could be 10 basis points to 30 or 40 basis points. So the merchant will drive acceptance, because for the merchant, it'll be a way of reducing their cost.
And it seems to me the younger generation, who's very suspicious of credit cards and use debit cards in their own life, will probably like the idea of this.
I think so. I mean, the valuation, I always think you kind of follow the money to some degree on these things. So the companies that are in this space that have been in there for a while, their valuations are stratospheric, to call it that. But there's a lot of serious money that's gone in there, not only from private equity, but also from large payment businesses, the PayPals of the world, the MasterCards of the world, the Visas of the world, because they see where this trend is going. And this trend in Europe, the regulatory framework came in 2018. The first payments really only started about a year and a bit ago, January last year. It's a 10-year, it's just be a fundamental shift of the way people pay. The US is a little bit different. It's almost open banking. They don't really have true open banking. They have more of what they call a screen scraping model. So I would have access to your account, but I'm looking at a screen. I'm not really looking at the underlying number to see is that the real balance, but it's close enough. And then in Australia, there are a couple of really small, I wouldn't say small, they're certainly burgeoning businesses, but they're privately held companies in this open banking space. And it's a very similar thing. Regulatory landscape changed on 1 July last year. The first real payment volumes kind of start clicking through the mid of 2022. And that's when we'll start to see that, really kick off as well. So, for this, I thought the reaction to the announcement was good, because it's not, A, it's not accretive in the immediate sense, and B, open banking in Australia isn't really here, right? So, for fund managers aren't that familiar with it, but in a couple of years' time, they're going to be pretty familiar with it, because it's going to be seen in a lot of different retailers.
Yeah, and I like the fact that you're diversifying your sources of revenue, and that's a good thing as well. Tom, thanks for joining us on the program. We look forward to your success in the future.
Thanks very much. Appreciate it. Thanks.
Well, we've been talking about stocks and trying to make money out of stocks, but there are other ways you can make money. Paul Myliotis comes from M Squared Capital, and these guys are actually in the property market, but they are providing alternative ways of trying to get a better return on your savings. Paul, great to see you.
Thank you, Peter.
Why don't you explain to people what you guys do?
So M Squared Capital, Peter, is a private credit provider, otherwise known as a non-bank lender. So what we do is we match investors who have money with borrowers that need money. Importantly, we provide our investors with monthly returns, targeting give or take a 7% net return to them, paid monthly every month.
Okay, 7% is a lot of return, and people watching this say, hang on, term deposits are only, 0.5%. Clearly, you're more risky than a term deposit, but do you want to talk about the level of risk involved?
Look, I think you can never put anything outside at the same risk profile as a
Government
deposit.
guaranteed term deposit, yeah.
So what we do is we generally lend our borrowers no more than 65% of the asset value. So simply what that will mean is for our investors to lose money, the property prices will need to drop by 30% or 35% before their capital is at risk. In saying that, we do mitigate risk in some very definitive ways. We only lend our borrowers on the eastern seaboard of Australia, so Brisbane, Melbourne, predominantly Sydney.
Yeah.
We don't lend specialised against specialised securities, so no pubs, no clubs, no bowling alleys. It's generally homogenised product.
Stuff that can be sold really easy and stuff that can be valued very easily.
Definitely. So when we look at where property markets go, it's more important for us to say, well, in a catastrophic event, if in the unlikely event we needed to take possession of the property and recover the money for our investors, will our investors get their capital back? And will they get their interest back? Now, historically in the Sydney market, in a homogenised property that you said, we've seen no more than a market drop of 20%, 18% give or take. So we can take COVID as a very good example in our business. All of our distributions were paid, no capital was lost, and all interest was recovered. So when we look at it, it's very important to understand in a catastrophic shock, will our investors actually get their money back?
Let's walk through an example, okay? I'm a businessman and I want to borrow $2 million for a project. A project that you guys, I guess, would look at to see whether you think it's a good project. And I've got a $10 million property. Well, how do you take security? How do you make sure there's some security behind
so
this,
first
this
of all,
borrower?
in that situation, we definitely consider it. It's a business purpose
Yeah.
with a property as a collateral. So we would lend in that instance on a $10 million property, no more than $6.5 million. That
So
business.
if I only want two, it's fantastic security behind a loan.
Exactly. So when we say about risk and where your return for risk, we are a weighted risk business. So when you are borrowing less, the return for our investor generally will be less. So it's a risk rating. When you're borrowing 20% of an asset value based in Sydney, you would say that the potential loss for an investor would be much lower than if you'd be lending 80% of that value, for argument's sake.
So as a borrower, you charge me less because I'm a really safe conveyance, covering 10 million borrowing too. And the flip side is the people who put money in to lend to me via you, they get a smaller return as well. But that means that the potential customers with you can actually work out how much risk they want to take and therefore how much return they want to get.
Well, that's a very, very good point. So in our business,
Is it a right point?
Well, it is for us.
Yeah.
So for M Squared Capital, we're a bit of a different fund in that we're known, and I know you don't like this word, but a contributory mortgage fund.
No, I hate that word.
I know.
Does anyone know what he's talking about?
I know.
Okay.
So what that means is, other people would have heard crowdfunding for argument's
Yes.
sake. But
Yeah.
what we do, and when we say we match investors and borrowers, we would, for argument's sake, go to an investor pool and put to them that specific investment opportunity.
Yep.
I speak about my father-in-law a lot on this show.
Yeah.
He doesn't want to hear the word construction, for argument's sake.
Or contributory mortgage.
Or contributory mortgage. So just going back to that point, we like our investors to be intelligent investors in saying they need to understand.
And they're sophisticated investors.
Sophisticated, but it's more than that.
Yeah.
They need to understand what they're getting themselves into.
Yeah.
There's too many stories in the marketplace at the moment where people have blindly given their money and then it hasn't turned out the way they wanted it to turn
Correct.
out.
Yeah.
With a contributory mortgage fund like ours, it's simple. There's a definitive project you're investing in. The project is a property-based security model. So you've got a residential house, a commercial building, you might have an industrial property.
Something's easy sellable.
Easily
if you know
sellable, but it's defined. We are lending 65% of that value. This is what your market return is. This is the borrower profile. Do you like that particular investment or not? That's what contributory is. It's a defined investment into a defined structure.
Yeah. You mentioned your father-in-law, but you haven't finished the story.
My father-in-law is a very conservative investor. He doesn't want to see anything that is got a construction flavour. He just wants vanilla existing properties with a nice vanilla return and low risk. But I've got touch about other people that we have as investors. We've got very astute property developers that are not doing property developments now, that love development, that understand that when you're lending money for construction, there's a bigger risk profile and their returns are higher, but they understand construction and they want us to provide those type of opportunities to them. So I suppose what I was touching with my father-in-law on the contributory side of things is that you have the choice to choose what you like. You're not just pulled into one asset class that says, I can give me your money and I can invest it under these particular parameters. I can do construction, I can do shopping centres, I can do regional.
You have a lot more control over where your money goes.
You are intelligently making your own decisions with your money.
Okay.
That's the point.
All right, other people are wondering, well, how safe is my money? Like what kind of governance controls are over what you guys do?
Look, I think any successful business is bigger than the people that are running the business. So Paul and I, we love our business. We're very passionate about the business. But if one of us, unfortunately, passes away or leaves the business, it's very important to understand what happens with the securities. So corporate governance is very important. We've got external custody, Perpetual manages that side of the business. We don't touch any of the money. The money goes to the custody. I think that's very important. Whenever you hear some bad stories in the media, it's because money was not handled externally. You've got external registry services, so you're getting your monthly statements done by external parties. We have our internal controls and managers. We've got internal lawyers in-house. We've got internal accountants in-house. But importantly, I think you need to look at the directors of the business, their track record. You need to say how the money is being handled, and also, which I think is one of the most important things, what are you investing in? What is the underlying security if something goes wrong? In our case, it's simple. It's property only, and it's always we can rely on that to recover monies.
Okay. That's Paul Myliotis from M Squared Capital. Well, I'm catching up with Ying Yi Ann Cheng from Coolabah Capital. And we all want to know what's going to happen to interest rates. Ying Yi, great to see you.
Great to see you, Pete.
Okay, let's start off with the question that most of my viewers care about is, do you really believe that central banks can keep interest rates as low as they are now until 2023 or even maybe 2024?
Yeah, I mean, look, the key concern for a lot of central banks, and the only reason why they would start increasing or hiking rates, would be largely because of inflation. So at the moment, we're not really seeing any inflation. For us to really start seeing signs of inflation, we probably need wage inflation, which, by the way, is fairly anemic. Wage inflation is under 2%. So we really sort of need wage inflation. How do we get wage inflation? Well, we need unemployment down. We need a tighter labour market. So, when we have a tighter labour market, then we will start seeing that wage inflation. But we're a fair way off yet. So the technical term would be the non-accelerating rate of unemployment. And that rate, according to Lowe, is, when I say low, RBA governor Phil Lowe, is probably somewhere in, possibly below 4% and we're some way off there yet as well. So, I think it's definitely conceivable that the RBA and other central banks aren't likely to hike rates anytime soon.
No.
However, that obviously doesn't stop interest rate markets pricing in future rate hikes. And that's what we've seen in the bond market. So the 10-year government bond yield has moved quite dramatically since February, and that's because they're taking into account inflation in the future, and therefore rate hikes in the future.
Yeah, but what duration of bond rates is more relevant to home loans and fixed rate loans? It's not 10 years, surely. It's more shorter term, isn't it?
No, it's not. It's not. It's not 10-year. It's the cash rate, and that cash rate isn't necessarily going to run away anytime soon. So yeah, any sort of mortgage rates priced off that cash rate. And however, you know, at the same time, you know, fixed rates have been very good. So the banks have been able to offer extremely competitive and, you know, dare I say it, probably the lowest fixed rate mortgages in history.
Yeah.
And that's care of the Term Funding Facility, the TFF, which the RBA introduced last year in response to the pandemic. And that's allowed the banks to borrow off the RBA out to 3 years at 0.1%.
Yeah.
And as a result, the banks have been able to extend that sort of lower cost of borrowing to, you know, mortgage borrowers.
Okay. Because you spend your entire life thinking about interest rates, let me ask this question then. We've seen some banks that were once upon a time offering 4-year fixed rates at under 2%. They've now taken that away and they're doing it for either 2 or 3 years, but not 4. So what are the banks thinking when they did that?
Yeah, good question. Well, maybe the expectation for them was that the RBA would extend that term funding facility. Now, the RBA has definitely decided not to extend that, so that rolls off in June.
Yeah.
And how I would respond to that would be, well, firstly, the banks haven't needed the liquidity. They're awash with liquidity, so they haven't needed to tap this term funding facility. And given that the RBA doesn't see the need to continue extending that, then they haven't. And hence, as a result, you're not seeing as many of those sort of 4-year sort of promises.
Okay. The thing that I get worried about is some really smart people like you, and I interviewed Hamish Douglas during the week, and you all seem to think that the Reserve Bank is going to be able to hold, and the Fed hold interest rates down for like 2024 is like really 4 years away. It's this year, next year. Like, if the boom is really, really big, I want you to put your real macroeconomic hat on here. If the boom is really big and inflation kicks, they're going to have to raise interest rates, surely. And
yes, of course.
Yeah,
of course.
okay.
When they do, they will. They will do so. I mean,
so the magnitude. So the magnitude of the boom going forward is going to be the critical factor.
Yes, of course. But we need to see those signs of inflation first.
Yeah. Okay.
When we do get that.
Yeah. Well, one thing I say, unemployment today came out down another 0.2%. What are we at? 5.6%. That labour market is tightening, but as you say, we've got to get to 4% before the Reserve Bank will think about raising interest rates. But we're heading in the right direction for a bit of inflation.
I mean, yeah, the economy is doing well, touch wood. Australia is faring quite well. So, you know, we benefit from having, you know, a strong commodity sort of sector, and we're, you know, relatively compared to the rest of the world, relatively unscathed. Given COVID in terms of its impact on our economy.
Okay.
And, you know, we've got an RBA that's willing to, you know, do quantitative easing to support the government bond market, and it'll allow the government, as a result, to create more infrastructure and more jobs here.
Okay. Now, before we wrap up, I've had a few inquiries from people who just don't understand the Switzer High Yield Fund, which you guys manage for Contango Asset Management, which I have a small share in. And I selected you guys because you're really good at what you do. So the Switzer High Yield Fund, what do you invest in?
It is an investment grade bond universe. So we're talking about bonds issued by the government. So the state governments like New South Wales, Victoria, for example, and it mainly invests in bank bonds and to a certain extent bank hybrids as well. Okay.
So it's not as safe as term deposits, but you're trying to make it safe-ish, given the fact that term deposits are paying you nothing. So you're looking at other stuff that you guys think is relatively safe and are paying better amounts. And so what are you hoping to achieve then on an annual basis in terms of your yield?
Well, the return objective is cash, which is 0.1% plus 1.5 to 3% after fees.
Yeah.
But I can tell you some of the bonds that we can invest in that portfolio rank above deposits, so they're safer than a bank deposit. You know, that's not true of the whole portfolio. And also the key point of difference is that, you know, the bonds that we trade are super active. So Coolabah in general is trading 70 to 100 times a day, on average $150 million a day. If you wanted to take your money out of a term deposit, obviously not an at-call cash account, if you want to take it out of a term deposit, there's, you know, a 30-day notice period.
Okay, now the history, even though this is new with my name on it, Switzer High Yield Fund, the actual style, the actual investment strategy you guys have been doing before, what's the track record like?
Very strong. I mean, you can go onto our website, www.coolabahcapital.com. We launched our first strategy or first fund in 2012. So all of the historical returns of the various strategies are there, and we're currently running 27 to 28 portfolios, including the Switzer High Yield Fund. Right,
and so if you guys have a real good year, you'd be expecting to get around 3.1%. A bad year might be 1.5 plus 0.1, 1.6.
Yes, but, you know, as always, you know, past performance is not a guide to future returns, and, you know, one should always read the product disclosure statement to better understand the risk.
Well, put it this way, if you guys don't do it, I'll have to come up to Bondi Junction and rip your bloody arms off, as Auntie Jack used to say. No, I won't do that. I won't do that. But okay, all right. So one last thing, people ask me, well, what is the fee for this? I got 0.7%, but is that is actually taken off before the actual return is actually announced?
Yeah, so the net return is after we meet the return objective and also after management fee.
Okay.
So that's the net return, but we charge. Are you talking about the performance fee?
No, just the actual annual fee. 0.7%.
Oh yeah, so the net return objective is cash plus 1.5 to 3%.
Yeah, and finally, when is the income paid?
Quarterly.
Okay, great, fantastic. Ying Yi, great seeing you. Talk to you in a few weeks' time. Join Paul Rickard, Hamish Douglas and myself and a range of other financial experts as we share with you key strategies to help you grow your portfolio at our 2021 Virtual Investor Strategy event taking place on the 27th and the 28th of April. Please join us. We are currently offering free registration to this event as well as a bonus 7-day free trial to the Switzer Report for anyone that registers. So get in quick and secure your spot via the link in the description below.